Okay, meet again in this PhD crisis, and today we'll try to do it in a bit different way because I will get my assistant. My assistant will help me in asking some question, and we'll try to answer some of popular topic question in economics. So let's try. Let's start. I think it's gonna be exciting. Okay, let's show where is my assistant. Hello, my assistant. How are you?
Hello, boss. How are you?
I'm good, thank you.
I heard you have such a difficult question?
Yes. No, actually, you're asking me question.
Tell me, I am curious.
Okay. So what's the question?
Identify the actions taken by the Fed to assist banks during the financial crisis 2008. Check all that apply.
Okay.
First, the Fed implemented new fiscal policy measures to encourage consumer spending.
Okay.
Second, the Fed placed a cap on the cash that individuals could receive from banks at one time.
Okay.
Third, the Fed bought securities to increase the money supply.
Okay.
Fourth, the Fed lowered interest rates, hoping to increase available credit.
Okay.
Fifth, the Fed carried out open market operations to stimulate growth.
Okay. So from all these five questions regarding the Fed, so as we know, the Fed is actually the central bank in the United States, and they only take care something connected with monetary policy. They do not take care anything connected with fiscal policy or even more restrictive about law and so on, or motivating people to use their cash or not. So from these five, definitely not the first one, right? So which one the first one? Can you
So
tell
why
me?
not this answer where? The Fed implemented new fiscal policy measures to encourage consumer spending.
So the Fed try to put more like something in fiscal policy. That's not correct, because basically a fiscal policy is the government program which needs the approval from the Congress or the House of Representatives. And this is not the responsibility of the Fed, especially on financial crisis 2008. Okay, and what's the second one?
And also, boss, why not? The Fed placed a cap on the cash that individuals
wait.
could receive from banks at one time.
So the other thing is the Fed cannot push the customer of the bank to limit them in pulling the money from the bank, and this is actually very dangerous, because imagine that you have $1 million in the bank and you need the money to pay for your new apartment. And you have to you'll not be able to pull the money because the Fed told you to not taking $1 million but just $25,000. The impact, then you will see any possibility to take all your money from the bank, and this can generate a financial crisis because everyone will not trust to keep the money on the bank. So this is something that any bank in the world never do, which is limiting people in pulling their money, because it makes people are worried. They gonna pull the money because they will just not trust on the institution and keep the money under the pillow. So that's the thing. So so it's end up on the three last option, which is the Fed bought the securities to increase the money supply. This is part of the real action on monetary policy that the central bank, in terms of increasing the amount of money supply in the market, either first in printing more money, which is a bit dangerous, because when you print more money, you basically need also supporting them with the current account, or like better export producing better value of the money. So you cannot just simply print out the money. So the way to do it is like you bought the securities from the market, like from private institutions or from government securities. When you bought them, it means you give more money to the market, and that will make the money in the market is getting increasing. So the Fed lowering the interest rate, yes, this is part of monetary policy, that you want to make people borrow more more credit or debt or whatever from the bank. So the way to do it is you need to lower the interest rate, because imagine if the interest rate is much lower than the inflation rate, people will start to borrow the money. They start to do the real activity. They start to build, their infrastructure, or they'll start to sell more. They start to making some on their own business, like car wash, whatever. And the last one, the Fed run the like real market operations to stimulate growth, and this is also part of monetary policy, because here is like they controlling the interest rate. When the interest rate lower, for example, then the growth or the activity of the economy is getting bigger. Like you, for example, YouTubers, when you want to buy a camera, you cannot bought it in a cash, you take a credit, right? And when you see that, oh, it's quite cheap actually to take credit from the bank, then you are more eager to then acquire the camera and buying it, and then you are posting a video on YouTube, you get more money, the economy growing, and so on. So yeah, so thank you very much for my assistant today. I hope the new format is cool.
Thank you, boss. I got it now.
I seen the up because the monitor is up, but yeah, basically that. So tell me, do you like this format of having my assistant talking with me? If yes, keep it in the column in the comment, and yeah, let's make making video fun again. Thank you very much. Bye bye.